Okay, so if you've ever uh, been through a separation with kids, you know that money arguments,
Yeah.
well, they're almost never just about the dollars and cents.
Right. They're tangled up with resentment, sometimes fear, definitely emotional leverage. It gets complicated fast.
Exactly. So today, we're doing a deep dive into the co-parenting budget planner. It's basically a system, a structure really, designed to take all that chaos and emotion.
And channel it.
Mm,
Transform it into something more objective, like a streamlined business partnership for raising kids.
that's a good way to put it.
Yeah. And that transformation, that's the real mission here. It's built on this idea of structure leading to clarity, transparency, and fairness, the CTF model.
CTF model. Got it.
Yeah.
So the goal for you listening today is to understand how this kind of framework, these objective metrics, can create real proportional accountability.
And hopefully prevent a lot of conflict before it even starts.
Okay, let's unpack the mechanics then. How does it actually bring about this financial piece?
Well, interestingly, it starts with behavior,
Not spreadsheets.
not immediately. Think of it first as like a behavioral contract. The roadmap actually makes both parents formally set up communication protocols. Step 3, I think.
Yeah. Step 3. So agreeing on how and when you'll even talk about money.
Precisely. And this is maybe the biggest conflict reducer right off the bat. It lays out specific do's and don'ts for those money conversations.
Like what kind of rules?
The big one is keeping the discussion laser focused on the children's verifiable needs, nothing else.
Verifiable needs. Okay.
Which means, in practice, you absolutely cannot use a bill as a weapon to, get back at the other person. And you definitely can't dredge up past financial arguments or grievances.
That's huge. Keep it neutral.
Totally neutral. Treat it like a small business partnership managing a shared project with the kids.
But okay, how does a planner enforce that rule? Keeping past stuff out when emotions are high.
It does it through structure. Strong structural barriers that kind of make the emotional arguments, well, less relevant to the process. Let's look at the fairness pillar again. The system mandates a really rigorous assessment of both parents' incomes. Everything.
Everything meaning.
Primary job, side hustles, investment income, the works. Total transparency. This is used to calculate the exact percentage contribution each parent makes to the combined income.
Okay, so you get an objective number. Like if parent A earns 70 GILs and parent B earns $30, the combined is $100. Okay, so parent A's contribution percentage is 70%, parent B's is 30%.
Exactly. And that percentage dictates responsibility.
Right, so it completely moves away from that often unfair assumption that everything should just be split 50-50.
Which rarely matches financial reality. This anchors contributions to actual capacity.
Right.
And that calculated percentage, it applies across the board.
To what kind of expenses?
Shared stuff like kids' activities, sports fees, camps, but also big long-term goals. Think college funds.
So because it's based on a mathematical calculation derived from verified income?
There's just less to argue about. The formula provides the answer. It objectifies the contribution.
Okay, now here's something I found really interesting for just day-to-day stress reduction. The automatic approval limit.
Ah, yes. That's a clever bit.
Why is setting this specific dollar amount such a game changer?
It tackles negotiation fatigue head on. You and your co-parent agree upfront on a threshold, let's say maybe $150, just as an example.
Okay, $150.
Any single expense for the child below that amount doesn't need a discussion. No text, no call, no back and forth. It's pre-approved.
Wow. So like new soccer cleats under $150, just buy them. Dr. Copay, just pay it.
Exactly. Think of the sheer amount of energy saved by not having dozens of tiny negotiations every month. It lets you focus bandwidth only on the bigger financial decisions.
That makes a lot of sense. And what about accountability? Keeping track?
Documentation is key. The system is meticulous about it, especially in the child support section. Every single payment logged requires a confirmation number.
A confirmation number, like from a bank transfer or a payment app.
Precisely. Or a check number, whatever provides proof. This transforms a simple expense tracker into a legally verifiable audit trail.
Which, if things unfortunately end up back in court.
Saves incredible amounts of time, stress, and legal fees. You have the proof right there. And it even guides you on modifications. It specifies that a significant change in income,
How significant?
defined as 25% or more, up or down. That 25% benchmark gives a clear, objective trigger for when it's reasonable to start gathering evidence to formally request a change. Takes the guesswork out.
Okay, so wrapping this up for you, the listener.
Yeah.
What we're really seeing is that this kind of robust, objective structure isn't just about budgets.
No, No, not at all.
It's the path to genuine proportional accountability, financial peace, and, importantly, that verifiable audit trail.
Which leads to a final thought for you to consider. The planner also asks you to track your own individual household fixed monthly expenses. Rent or mortgage, car payments, debt as a percentage of your income.
Your own separate household costs.
Right. Now, why might knowing the financial stress level, the debt load or housing cost burden of the other household be strategically valuable for your shared plan? Think about it. Understanding their potential financial instability implicitly encourages more proactive communication. Maybe before a problem impacts their ability to contribute consistently to the kids' needs. Food for thought.